Okay, thank you, Tolutope. So what we are saying now is that money has value, money has time, and after a while, the value of money depreciates. And so as an engineer, you need to follow it that way. Okay, I don't want to read all this so that I just want us to go into the main thing. You say $1 today is worth more than $1 in the future because money has earning power. In other words, if you put $1 in the bank where it earns interest, it is worth more than $1 tomorrow. This change in value over time is called time value of money. Some have called this the most important concept in economic analysis. As an example, think of the price of a car. In 1980, a car would have cost about $20,000. Today, a car is about $30,000. So in about 30 years, your initial $20,000 would only pay 2/3 of the current cost of a car. This, the value of $1 falls as time moves on. Okay. Okay, I think I've done that. Okay, so I'm going to introduce us to financial terms that are used worldwide. Well, I'll repeat this again. These are some of the terms that maybe during our university days in Gym 401, we just heard about them. But it's good that today we will take an in-depth look into some of them and how they are applied, especially in real-life scenarios. The first term used in financial term or in cost engineering is the annual value. Let me repeat again. Tomorrow we'll be talking about cost estimation. We are starting with financial and economic analysis, which is something I feel is a new thing. So I want to start with what is new before we go to what is old. Tomorrow we'll do what all of us know, which is cost estimation. How to estimate for your materials, your cement, your sand, all those stuff, your formwork, and what have you. But today, let us talk about what is new in engineering and what is new in cost. So when we say annual value of a project or annual worth of an investment, what are we referring to? We are talking about a series of cash flows, most often savings in our application, that occur evenly spaced over time. For this course, we will use end of the year accounting, meaning that cash flow occurs at the end of the year. It is also known as the annuity amount. So it's either you call it annual value or you call it annuity amount. And in other parlance, they also call it annual worth. Annual worth, yes. And if you use it to solve a question, you call it the annual worth method. So that is annual value. So what is annual value? Let's say you make an investment in the business and that business is bringing you 5,000 every month. If you accumulate it into a year, which is going to be 60,000, that becomes the annual amount. Becomes the annual investment, the annual worth of that investment. So or you collected a loan from the bank and the bank has structured your loan and said, you'll be paying us so amount of money, which comprises of your principal and your interest, so that at so number of years, you would have paid up all your debts. So that equal series of amount of money that you have to pay back to the bank, or let's say a mortgage, is what we call annual value. So if you buy a car, let's say you bought a car for 2.5 million, or let's say you bought a car for 2 million, and the cost of this fueling it over a period of 5 years is 500,000. It means that the total cost you spend on that car is 2.5 million. If you divide that 2.5 million into 5, that will give you 500,000. That means the annual worth of that car is 500,000. That's what it just means. Okay, the second term is what we call the present value. You represent it as P or PV. In Excel, it is known as PV, present value. You can also see some people represent as P or principal. So you say it's the value of the future amount in today's dollar. Okay, Let's say you bought your iPhone 300,000 2 years ago. That is not the present value of the iPhone. The present value of the iPhone is the value as at today. Let's say you built a house with 30 million naira. That is the present value of that house. In the future, that house might be worth 50 million. But the present value as at today is 30 million. So that is the present value. So the present value is also in form of the contract sum. The contract sum as at today, the contract sum of a project, or the cost of a contract, or the cost of executing a project as at today. In other words, if you go to the market based on the price of cement, based on the price of reinforcement, based on the price of formwork and everything you have, that represents the price of that project as at today, which might increase tomorrow or depreciate tomorrow. The next term is the future value. The future value is represented as F or FV, and it is the value of a single deposited amount or series of payments at some point in the future. So when we say future value, we are talking about the future of your investment, the future of your project in the future, sometime in the future. That's why you see sometimes if contract is awarded at, let's say, 2 billion naira in 2020, by 2022, if that project is not concluded, you'll start seeing reverse costs. Why? Because there is time value of money. So if the contract is 2 billion today, it does not mean in 2 years' time, in 3 years' time, that the contract, the project is still 2 billion. It is not possible. Or let's say you took a mortgage and you are paying a certain amount of money. And if the mortgage is structured for 5 years, after 5 years, well, you're not going to pay the same amount again. Okay, so the third term is what we call life cycle costing, LCC. And it says the life cycle costing is the sum of the present value of all costs of a system over its lifespan. Life cycle cost analysis, LCCA, is the overall process of including all of the associated costs and savings of an asset or project over the complete life of the project or assets within the economic analysis. So that is what life cycle costing means. It simply means if you are doing a project, if you want to cost a project, you are not only looking at the initial investment costs, we are looking at the cost of maintenance, cost of transportation, your logistics, staff costs, cost of capital. Yes, you borrow the money or you took the money from the bank. So there's a cost of capital, the inflation rate. So by the time you build in all those indices into your project, you are going to come up with a sum which is in the present. That sum must be in the present. And that is what life cycle costing. So you'll be able to take into LCCA. You've done a life cycle analysis. The next term is the NPV, which is the net present value. And we say it is the difference between the present value of an investment, the present value of an investment future cash flows. So, and the initial investment. So, in other words, the difference between the future cash flow and the initial investment will give you the net present value. Of course, we all know whenever you see net, net means something subtract by something. So it means the future, the present of your future minus the initial investment will give you the net present. In other words, let me give an instance. I bought a phone for 100,000. I used the phone to do a business over 1 year, and I got 150,000. The net present value of that phone is 50,000 because the income coming from the phone is 150, and the present value of that cost is 100. Excuse me, please. One of us is calling. Let me know why he's calling, please. Okay. So that is your net present value. Then the next one is what we call the internal rate of return. Okay, apologies, please. Okay, so the internal rate of return is the discount at which the present value of a project equals the present value of the project savings. Now, don't be confused. I'm going to explain these things using figures and copious examples. So when you talk about internal rate of return, Engineer Omeize, you can't hear me. No, it's from your end. I think everyone can hear me. Please, can you all hear me? Can we respond? Let's be on the same page. Okay, so the internal rate of return, or IRR, is the discount. In other words, it is an interest rate. Now, when we talk about interest rates, it can come in different words. The words can be used interchangeably. It's either you call it interest rates, you call it discount rates, you call it hurdle rates, you call it what other rate? Financial rates, or you call it cost of capital. So it can use different words. You can use different parameter to call it, but they all means the same thing. It simply means the interest rate at which the MPV is equal to 0. The interest rates at which the MPV, in other words, the interest rate at where you break even. Where you break even, that is what your IRR is, internal rate of return. What does internal rate of return does? It helps to give you an idea where you cannot go below. You know, if you're negotiating for a project or for a cost of a project, it is good for you to have your own internal cost to say anything below this, it is no more profitable. In other words, any negotiation must be from, let's say, 15%. Okay, I told people that companies like Julius Berger, before they go into a project, they must make sure they are seeing a clear 50% profit. Some people can take 10%, some people can take 5%, but I don't see anybody taking something below something that will make you run at a loss. So it depends on your borrowing cost. If you borrowed at 10%, then all you need to do is to, let me just give a simple example, a very simple example. Our banks, CBN normally gives them rates at 11.5, 12%. But I can bet you that most of our bank now place their internal rate at 18%. And then when you come to take loan from them, they'll be giving you at 20, 22, 25%. Now, between what CBN gave them and what they placed as their internal rate, they have captured their cost of their running costs, staff cost, cost of paying their staff, cost of paying, servicing their loans, and cost of every other logistics. That is why when CBN gives them at 11%, they don't give you at the same percent. And then CBN itself, they only place the interest rate at 11% based on the rate of inflation. They use inflation as, because what they'll do is that they cannot give you money, and tomorrow if you are paying back the money will not have the same purchasing power. Okay, so let me go quickly so that we can go into the calculation, because we're going to do a lot of calculation today. The next one is interest rate. So why I'm taking my time to emphasize on these terms is that these are the terms you'll be encountering in cost analysis, in cost terms. This is what you'll be hearing most of the time, apart from cost estimation. The next one is the interest rate, represented as I. He said this term can be used different ways. If you are borrowing money, you call it the finance rates. If you're investing money, you call it the interest rates. And if you are trying to move backward in time, you call it the discount rates. Then some other people call it the hurdle rates. So I have used up to four terms. All these terms can be used interchangeably. Discount rates, interest rates, finance rates, cost of capital, hurdle rates, they all means the interest, depending on where you are coming from, whether you are borrowing or you are discounting. Then the next term is what we call the minimum acceptable rate of return, MARR. He said this is the rate determined by a company or organization to be the minimum allowed required for investment. Let's say, for instance, you as an engineer, you can tell yourself, if your friend comes to borrow money from you, you tell him to give you 5% interest, 10% interest. Or if you are investing in a business, if the interest does not meet your minimum acceptable rates, you will not loan the money or you will not go into that business. So that interest rate where you have set as your margin, as your breakpoint, is what we call minimum attractive rate of return. What it simply means is that anybody that's doing business with you cannot do business below that interest rate. It only has to be higher or nothing more. Okay, then the next one is we call depreciation. Depreciation is amount of economic value that is used up during the accounting period. Depreciation is not a cash flow, but it's for accounting purposes only. So the depreciation is an economic value, okay? Is the rate at which something loses its value. The next one is payback period. Payback period is simply the number of years needed to recover an initial investment. The number of years needed to recover an initial investment. So we have what we call the simple payback period, and we have what we call discounted payback period. The simple payback period is just simply the principal divided by the annuity. Let's say you borrow me 5 million and you want me to pay back in 5 years. Yeah, you borrow me 5 million and I'm paying you back 1 million every year. It means 5 over 1 means 5. So it means the payback period is 5, which is 5 years. So this is the amount borrowed or the principal. This is A, which is the savings or the annuity or the income. So if you divide the principal over the income, you're going to get the number of years to pay back that loan or that money. But the one that also used is the one we call discounted payback period. In other words, it is calculated after discounting the net cash flow by using a minimum attractive rate of return. So the difference between the simple payback period and the discounted payback period is that the discounted payback period takes into account the time value of money. It takes into account the time value of money. In other words, if you borrow 1 million today at 10%, after 1 year, it is 1,100,000. Or let's say you borrow 10 million, let me use in million, 10 million at the rate of 10%. It simply means after 1 year, that 10 million becomes 11 million. After 2 years, it becomes 12 million. Huh? So if I use that discounted, that time value of money, compute the time value of money, the payback period, it becomes what we call the discounted payback period. We're going to see how to use Excel to do these things. Salvage value. What is salvage value? It is the value of the equipment at the end of the project life. So sometimes salvage value is positive if you can sell the equipment, and sometimes it is negative if you have to pay somebody to remove it or dispose it. Salvage value is usually ignored in this section, but it does not occur in a problem. Treat it as a future value. So if you buy something, equipment, and you're using it, after a while, the equipment will lose its value so much that it might not be economical for you again. So at that point, you have to dispose it, you have to discard it. So if you're going to sell it and get a small amount of money, it's a positive payback period. Then if you're going to pay it, if you're going to pay somebody to remove it, then it's a negative salvage value. So, but in most calculations that we do, we usually ignore the salvage value. We assume that at the end of the project, the salvage value is 0. So in most contracts, in most projects we undertake as engineers, the salvage value is usually 0. Some of us, when you buy something, at the end of this lifespan, you cannot sell it again because you have already exhausted every value in it. And sometimes we will have to pay somebody to come and take it out of our compound. Then the next term you've been seeing is the life of the project. You know, when anybody asks you what's a project is simply something that has a beginning and an end. That is the universal layman's definition of a project. So anytime you want to call something a project, just know that what you meant is that it has a beginning, it has an end. So when you say I'm handling a project and the project does not have an end date, then that is not a project. But I don't know what it is. So in every engineering cost analysis, there must be a lifespan. You must attach a lifespan. If the project seems to be infinite, then you must model it in such a way that at some point, its economic value would have been maximized. Okay, so all the terms that I have explained to us brings us to 5 of them. So all the things that I've talked to us about, I would like you to take cognizance of 5. 5 are more important, and 5 are more recurring in our project analysis. In other words, you'll be encountering these 5 more often than not. And the first one is the present watch. We'll be representing as P. The second one is the F, which is the future watch. The third one is the A, or the series, the annuity, which is A. The savings, the annuity, the annual value, the annual what? That's A. The third one is your N. N can be the lifespan or the number of interest period. I want us to take note of that word. Number of interest periods. Some projects, the interest period is monthly. Some projects, it is yearly. Some projects, they are fixed. They are fixed, like 2 years, 3 years, fixed. But in most projects, in most economic projects, it is an annual thing. Even when you go to the bank to borrow money, they bill you annually. When you take a contract from government, they ask you to complete it in so number of years. So the year, the N, is synonymous as number of years or lifespan. But then take note that some projects, the interest period can be weekly, can be daily, can be monthly, although majority of them are annual, yearly. Then I will always represent interest rates. Whether I'm calling it discount rates, hurdle rates, financial rates, minimum attractive rate of return, whatever I'll call it in none of these 4, it still means interest in terms of what we're doing today. So he said the most common engineering economy problems involves the use of N and I, and at least 2 of the remaining 3 terms. So in most of the problems, N and I will always be difficult because every project must have a borrowing rate, must have an interest rate. Even if the project does not have an interest attached to it, you know that there's always inflation or depreciation. Those ones are natural phenomenon. Things depreciate over time, and things also inflate over time. So I and N are always present. So the 3 that I want you to take note of are these 3, 1, 2, and 3. Let's talk about cash flow. Every project has receipts. So in our cash flow, anything that comes in is positive, and anything that goes out as a disbursement is cost. So there's income, there's cost. So net cash flow is always your sum of your receipts minus the sum of the disbursements. So since each receipt or disbursement takes place at a certain time during interest period, a simplifying assumption is made that all cash flows occur at the end of interest period. This is known as end of period convention. Most things that we do, both in Nigeria and in our businesses, is always end of the year period convention. We give interest, we pay back our loan at the end of, if we borrow money in January, we pay back in December. If we do something in January, accountant will come in December and do internal audits. So our system, our life is always an end of the year stuff. Even our budget in Nigeria is always at the end of the year, they'll come up with the budget, and from January, we start implementing it, even though that has not been the case, but then that should be the model. So this is what the cash flow diagram looks like. Anything that comes in positive goes up, and anything that's negative goes down. That's what cash flow looks like. You can read this and understand this. So look at what we're talking about. Present value. He said, what is the present value of 10,000 naira to be received 5 years in the future? In other words, what is the future value of 10,000? And we found out from our calculation that it is about 6,200. So what does it mean? What does it mean? It means that 2,600 today is going to be worth 10,000 in 5 years if the interest rate is at 10%. So if you are moving backward, you call it discount. You are discounting this money. If you are moving forward, you call it interest. So the opposite of interest is discount. So it depends on whether you are moving from the future to the present, or you're moving from the present to the future. So in this case, we are saying, what is the present value? So what it means is that it's either you are giving me 6,200 today, or you are willing to give me 10,000 in 5 years. It all means the same thing. So if I discount 10,000 for 5 years, I will come down to 6,000 based on inflation rate, interest rate, discount rate, whatever name you call it, hurdle rate of 10%. Okay, we're getting close to starting our calculation. Now, what we just discussed now can be put into 5 formulas. So this is 1, 2, hold on, 2, 3, 4, 5, and 6. Yeah, about 6. So any question in cost economic analysis can come in form of any of these 6 questions. Meanwhile, let me say this. This training will lead you to 3 certifications. This training we are doing today. This training can lead you to become a certified energy or audit manager. It can lead you to a project management professional. It can also lead you to certified cost professional. By next year, I and my partner, we're trying to bring in just like you have PMP, we want to bring in, though it's already taking place, not that we are the ones starting it. But we want to start training people on becoming certified cost professional. We call it CCP. CCP, that way, when you put your name, if you didn't put PMP, you didn't put CEA, you can put CCP. So CCP will be like a professional title, making you a certified cost professional. So that is part of where we took this curriculum from. So they normally write some exams, but I'm not going to that, but I just want to let you know that there's a bigger vision, bigger package for this. If you want to go further on this, you can also write an exam and become certified in it. Any questions so far? No question, I guess. Okay, so now the first mathematical term, or the first solution to a mathematical term is what we call the single payment compound factor. I'm going to be introducing you to 6 of them. And those 6 of them are what you have here in your interest table. This is your interest table. If you go to interest table, you will see that the first one says compound amount factor. The second one says present worth factor. The third one says sinking fund factor. This one says capital recovery factor. What this thing simply means is that in any economic terms, one of them will fit in. Is either you are looking for, you are trying to recover capital from a project, or you are trying to compound the future amount of a project, or you are trying to get the sinking fund. Sinking, when you heard the word sinking, it simply means those money that you pay in for some investment that you cannot recover. Okay, somebody say, how does lifespan of each project affects the life of a project? Well, as a project is nearing its end lifespan, the value of the project depreciates. So The lifespan of a project also determines the amount of interest period that you have to pay. A contract that is a project that is worth 5 years, if you extend it to 10 years, you might find out that at the end of the day, it might be penny wise, pound foolish. So the lifespan of a project or of each equipment, okay, lifespan of each equipment. Well, the lifespan of each equipment determines the cost price, the cost of the equipment. The larger the lifespan, the higher the cost. You can unmute yourself if you are not satisfied and ask so that others can also learn. How does lifespan of each project affect the life of the project? Okay, let's continue. So, in engineering cost engineering problems, if you are to find the future value of a project, this is the mathematical formula. And then this is the formula you can use. This is how it's represented. I will explain this. It might look complicated to us. Future value is present value multiplied by 1 plus the interest rate raised to power minus the number of years. This is the formula most of us know in our school days, but I'm not going to bore you with these formulas. Notation, hold on. So this is the formula most of us know. If you remember our school days, you want to find the future value of an amount. But today, we're not going to be doing all these calculations. Rather, we're going to use interest table and then use Excel to do them. So, but it's good for you to know how the formula is, how we came about the formula. If you are using interest table, this formula will be put in this form. It will become future value. You now go to the interest table and look for the factor that has the future value over the present at a particular interest rate and at a particular number of years or interest period. So what you have here is what you're going to look out for in the table. In other words, if you come to this table now, if you come to the interest table, for instance, hold on. If you come to this interest table now, you will see that this one, like the first one, look at the first one, it says, what you're looking for is a compound amount factor. He said, find F given P. If you want to find the future value and you are given the present value. So this is the column you are going to use. So that is the same thing that this place is talking about. You're looking for the future value and you're given the present. So you just go here and find the interest table. Okay, let me not complicate it. The second one is if you're looking for the single payment present worth. This is the formula you're going to use.
So please, can you go back to the first one again?
Okay. This is it.
This one is single payment compound amount. Okay.
Amount, yes.
Second one.
The second one is like the opposite of this one.
Single payment present worth
factor. Yeah. So it's like I want to know the first one is you are looking for the future value, but you are given the present value. So you simply multiply the present value by, okay, let me give an instance, very practical example. If I borrow 10 million at 10% interest, I borrow 10 million at 10% interest. How do I know the amount I will pay back after 1 year? This is it. I'm borrowing 10 million. Okay. And the interest, the I, is at 10%. Are you with me? Yes. So the number of years after 1 year is 1. After 1 year, what I will pay back is future value equals present value into 1 plus the interest rate raised to power n. All of us know that I'm going to pay back 11 million, but how do you get about 11 million? It's simply 10 million into
1 million.
1.1. Thank you. Thank you. 1.1 raised to power 1. So if you multiply 10 by 1.1, you're going to get 11 million. But the good thing is that we're not going to be doing all this mathematics. Nobody's inventing the wheel again. All this mathematics is gone. The current thing that is in vogue is the interest table. And the interest table is an open source. If you go to online now and you try to Google interest table, you're going to see 1 million of them. Okay? You know what I tell engineers is that anytime you're doing your design, you should have Google around you. Just have Google around you. Anything you need, you can Google it. For instance, now if you go to Google now, you say interest table. Watch me, gentlemen. Look at it, has come up. Interest table. You can see there are 1 in a million of them. If I go to images now, you see they are just, so it's just like 4-figure table that we have in the university. Or for those that are civil engineering, remember our structural design, we always make use of charts. Charts, everything is chart. Column design, we make chart. Reinforcement design, chart. So most of our design we do, or most calculation we do in engineering, they are always charts. So at our level, at our age, you don't need to do mathematical calculation again. Just use the interest table. Okay. Then if I want to use interest table to get my 11 million, what I will just do is I will go here. First of all, since the interest rate is 10%, remember the question, I borrowed 10 million at 10% interest. After 1 year, how much will I pay? We know that the answer is 11. So what I'll just do is I'll go to the table that has 10%. So this interest table has percentage. So there are about 32 sheets here. So these are 2 sheets is simply every page has a particular interest that is taken care of. So this one says 1/4%, which is 0.25. If you go to the next one, this is 0.5%. So all the interest table are the same. What differentiates them is just the percent we are working on. So this one is 1%. So if I'm working on based on 1%, this is what will come. If I'm working on 2%, I'll come to page 9, 2%. The next page will be maybe 3%. Okay, 2.5%. The next one, 3%. So gentlemen, just be looking at it, ladies, be looking at here. So all the interest table is just one sheet, but multiple interests, as in based on 5%, 10%. So what I will do, I will scroll down and go to 10, this is 5%. So I'll go to 10%. This is 18%. This is 12%. This is 10%. So this is 10%. So what am I looking for? I'm looking for the future value, and I've been given the present value. The number of years is 1. So n is 1. So this is n. So n is equal to 1. And it is a single payment. If you look up here, you see that it's a single payment. Okay. In other words, I borrowed 10 million. I am paying back 11 million. How do I get 11 million? So what I'll come here, I'll just come here. Since I'm looking for the future value of 10 million, and I have been given the present value. That's why this thing says find P, find F, given P. So I was been given P, I'm looking for F. So, and for what year am I looking for? For the first year. So the first year now says 1.1. So if I now multiply the present value by 1.1, I will get the 11 million I am talking about. Hold on. Okay, so it's in the right place. So, so that is that. Okay, I can see my screen. So that is that. So in this place now, if you look at it now, you find out that what I did now was to go to the interest table and look for this factor. And this factor says, given P, given F, given P, sorry, whatever that is down is what is given. And whatever that is up is what I'm looking for. So here I'm looking for F, and I've been given P, I've been given the interest rate, I've been given the number of years. The number of years is what? 1. The interest rate is what? 10. And the principal is 10 million. So the future value is what I just got now by going through my interest table. Okay, can you hear me now? Is Engineer Izuchukwu? If you can't hear me, it's from your own end. So the second one now is the opposite of the other one, which means I want to get 11 million in my bank account after 1 year. How much should I deposit now? If the bank is going to give me 10% interest, please, who can unmute himself and give me the answer? After 1 year, I want to get 11 million. How much should I deposit in the bank?
Going by the same 10%, then it has to be the same 10 million that I should deposit.
God bless you. So let's now use, thank you, sir. Now let's use interest table. And so we'll do backwards, we'll move backwards. That is why, if you see here, the present value is what I'm looking for. And I'm giving the future value. So I will now say the future value divide by 1 plus I raised to power n. And if I'm using interest table, so we'll now call this discount. So I'm going to discount 11 million by 10%. That's what it means. Then if I'm using the interest table, it simply means that I will now say, looking for the P, looking for the future value, the present value, given the future value. That's what this equation means, this symbol means. It means I'm looking for the present and I am giving the future. So what I will do when I come to my interest table, since we are still on 10%, I will now go to find P, given P, and the formula is 0.9091. So if you multiply 11 million by 0.9091, and so let's see what that would be. Let me bring calculator. Stay with me, please. Okay, so the interest fact, the table factor says 0.9091 multiply by 11 million. Is that 11 million? No. What's the answer? 10 million. Forget about the 100 naira. So this is 10 million. So what it simply means is that if you're looking for the future value, if you're looking for the present value, divide the future value by the interest rates plus 1, which in our table, in our interest table, we got it at 0.9091. So at this point, I would like everybody to open their interest table so that you can really be on the same page. Can you go to your folder, those that have the material, those that have paid and got the material? Please, if you have paid and you have not gotten the material, please chat me up on WhatsApp or chat me on the chat box. I'll send you the material. So open the interest table. If you've not gotten the material, please let me know. So this is it. I'm sharing the link now. So open your interest table, please, so that you understand this. So you don't need to memorizing, let me say this, let me digress a little bit. One of the unfortunate things about our educational system, which we borrow from the British, is that we are more focused on how to cram things, how to memorize things. But in modern engineering now, you're not supposed to, as an engineer, you're not supposed to memorize anything. You're not supposed to cram anything. Our children are not supposed to cram or crack their brain because everything is in open public domain. This interest table is, you don't need to cram the cover to reinforcement as a civil engineer? Just go to Google. You say for 2 hours fire, fire resistance, what is the cover to reinforcement? What is the yield of high yield reinforcement? You Google it. What is the spacing for? Everything is online. If you come to our renewable energy class, which me and my colleague take, you find out that in teaching you design, we try to make people to understand that, look, you just have to have your materials, your interest table around you. Okay, you just have to cut the materials. Engineers in there, have sent it to your WhatsApp already. I've sent it to your WhatsApp already. It's also on your chat. Thank you. The link to the material. So this formula, I'm going to show you more formulas anyway, but I won't advise you to cram any of them. And this is another formula. This is becoming more complicated now. If the payment is now a uniform series something, this is the formula for it. But please don't cram anything. All you need to cram for me is the interest table. What to look at for an interest table. Because even in the modern exams these days, most professional exam these days is always open book. That's to tell you how things have changed. Some of us that are here, that studied in Europe, you'll bear with me that in some of our exams, it's open book. How much more your design? How much more for you to do your cost model, do your cost engineering, which you can do at the comfort of your office. You don't need to cram anything. You just need your charts, your tables, and your computer and your internet, sorry. And you can now Google and do your design. So this is just one of my message to the future engineers. We don't need to crack our brain and damage it. Everything is online already. Okay. Now, the third one, remember, we've talked about the two. The first two we talked about is single payments. I borrow 10 million, I'm paying back 11 million. Or I want to get 11 million, how much should I put in the bank? So it's a single thing, it's a one-off thing. But now we go into what we call uniform payment series. In other words, it's no more a one-off thing, it's something you have to do periodically, it's something you have to do yearly. So it becomes more complex, more complicated, and more tasking. So the first one is what we call uniform series present worth. A formula developed to determine the present worth of a given equivalent uniform end of the year. Okay, let me explain it in a layman's language. Is either you give me 1 million today, sorry, is either you give me 10 million today, sorry, let me use 5 million. Is either you give me 5 million today, or you give me 1 million in the next 5 years. So is that I choose for you to give me 1 million one-off, or you split it into 1 million. But the question is that based on time value of money, it might be better that you give me 1 million now than you give me 1 million in the next 5 years, because at the third, fourth, fifth years, that 1 million might be worth 700,000, 800,000, but we're going to find out. So that is what time value of money is teaching us. That is what life cycle costing is teaching us. That is what cost engineering is all about. For you to be able to engineer cost today, tomorrow, in the future, and based on any internal changes that's happening. Gentlemen, one thing I'm sure, I'm close to those in FCDA in Abuja where I base. There is no project in FCDA that have not received 150% variation. There are some projects today that their variation is 200%. Among other factors that have contributed to such abysmal engineering costing is the lack of knowledge of cost engineering. I will explain. Apart from corruption and the government's inability to pay as at when due, that one, and then cost of borrowing, cost of inflation. I know those ones are a factor. But also, as an engineer, if you are supposed to finish a project in 2 years or in 4 years, you should not just use the present value of the project to evaluate that project. And if you are doing your bill of quantity, your bill, your BEME, be looking at the future, be looking at the end life when that project will be completed. It's just like in one of my training, when we're talking about water reticulation. Before you do water reticulation, the first thing you do, you must do what we call population projection. You must project your population to the future. And it is that future value that you use to do your calculation. That's why if you're doing a design, if you're designing a project, you must define the lifespan of that project, because the lifespan of that project will help you to know the population equivalent to be used in case of water. It will also help you to know the sizing of that project. If you are designing a 50-year return period for flood, then you should know the kind of system you're going to provide. You're going to provide a system that will accommodate the worst rain that will happen in 50 years' time, or in 20 years' time, or in 5 years' time, depending on your design value, your design, the peak flow you are using. Let me not digress. So the next one is what we call capital recovery. What is capital recovery? You want to buy a car and you don't have all the money, and the dealer now said, just like what they do in Europe, okay, since you don't have all the money, you're a salary, you're a government worker, you can be paying me so amount of money every year for you to be able to pay back the cost of the car in so number of years. That is what we call capital recovery. It is the uniform series of payments that you have to pay in order to recover this P. Okay, you say, can you throw more light on uniform series present words? Okay, thank you, sir. I'm trying to go back. Just hold on. Okay, uniform series payments means if somebody wants to pay you certain amount of money in the next 5 years, what is the worth of that money today? Oh, I'm going back to school, and my father said he will be giving me 10,000 every month over a period of 1 year. Let's say a smart guy will say, okay, 10 times 12, that's 120. Daddy, why not just give me 120 now? That 120 is what we call the present worth of the series. So looking at the formula, it means you are looking for the present worth, but you are not giving the future worth, but you are giving this equal series payment that comes annually or comes monthly, depending on the payment period. So he said to find the present worth, knowing the equivalent uniform annual amount for years. That is why mortgage companies, if you have a knowledge of this thing, if a mortgage company wants to give you house at a mortgage and say, you'll be paying us for 1 million for the next 10 years. If you do the calculation, you might find out that it is better you pay them 8 million now. But if you have to pay them over a period of 10 times or 10 years, they'll ask you to pay them 1 million, which will amount to 10 million. But if you are paying it now, one-off, the money might be 7 million or 6 million. So that 6 million is what we call the present worth. And that 1 million is the A, annual annuity. I hope it makes sense, sir. Then we're going to the next one. So the next one is what we call capital recovery, which is just the opposite of the last one. Capital recovery, in this case now, I don't have the whole money. I cannot pay now. So I want to pay in small installment, which is A. I want to pay in small installment, but I have been given the present worth of it today. But because I don't have the money, I want them to split it for me over a period of time. That is what we call capital recovery. I think that's what they call it in the MBA class or so. Please, we'll go into the question shortly. Okay. So, Victor, you can get the material in your chat box. Okay, so that is that. Now, we'll move to the next one. Sinking fund. When you hear sinking fund, what does it mean? I'll explain. It simply means how much amount should I be paying for me to pay up and achieve a certain future sum. Let's say I want to buy a house worth 50 million and I want to own the house after 25 years. How much will I be paying? How much will I be sinking into the mortgage company so that after 20 years, I'll own that house? That's what we call sinking fund. How much will I be sinking into this? How much will I be sinking? Or let's say I want to, another example I usually give people is that I want to send my son to school in the US in the next 5 years. And the school fees in the US in the next 5 years is about $75,000. So how much should I deposit in GT Bank today at a particular interest so that in 5 years' time, I will be able to achieve 75,000 in that account? That is what this one is talking about. So we call that sinking. Some of us that know about sunk fund, sunk money. It means how much you'll be sinking. There is someone who want to buy a land or want to buy a property. You'll be paying a certain amount of money with the expectation that in a certain number of years, you own that property. So this is the formula to get it. So it is written as this. And in your interest table, you'll find it somewhere here called sinking fund. Look at it. Given A, find F. And it is the opposite of this. Okay, now we'll come to that shortly. Okay. Let's go to the next one. The next one, and which is probably the last one, is called this one really comes out, but it's called the uniform series compound amount. What it simply means is, what is the future of a uniform series payment? If somebody is giving me small money, maybe every year or every month, depending on how we agree, what will be the future sum of that money? What is the future worth? It is easy to say you multiply by number of years. No, you get it wrong. Why will you get it wrong? Because there's deflation, there's inflation. There's loss in value, there's time value of money, because money has to be discounted. Okay. Now, so that is that. Now, the next one is, now we are going to the calculation. Please give indulgence. I wanted to stop this by 4 o'clock, but it is good that we lay a foundation in 1 hour 30 minutes. So in the next 12 minutes, I'll be done with this. Then we'll go into solving questions, solving calculation, and that will help us internalize some of these things and also enable us to ask questions. Those of us that are joining us, the program is in 2 parts: business cost investment appraisal, economic analysis, which we are doing today, and cost estimation, which we are going to do tomorrow. So tomorrow we're going to talk about cost estimation, which is, I know some of us, that's what we came here for. Please, I gave indulgence. At the beginning, I said I want to treat this because it's a new area of knowledge that our engineers, they just brush us through university, but they don't go in depth. But it's time for us to grab it. Okay. Now, all what we are saying, in order for you to use the economic table, I'd like you to understand how the analogy is. The 5 terms we have are these: PAIN, where I is known as interest rates, discount factor, minimum acceptable rate of return, or in some cases, internal rate of return. So this is what I is called. N is the number of years. A is the annuity. F is the principal, or the present worth, sorry. And F is the future sum. Now, factors in the table in all economic tests, they are tabulated like this. Whatever that is up is what you know. What is what you want, sorry, what you're looking for. then whatever symbol that is down is what is given. So if you see something like this, what it simply means that P is what you want to find. A is given, I is given, N is given. So that's why you say P over A, I, N means everything down here are what has been given, what is known, or given what I do know. I know these values. Then whatever that is up, or the first one, is what I want to find. So if I write this thing like this, what it simply means, find P, given A, I, and N. So that's what this thing means. So if you go back to this formula now, this thing means find F, given A, I, and N. This one means find A, given F, I, and N. If I go back again, this one means find A, given P, the interest, and the number of years. Mathematically, find A, given P, and then this formula comes in. This formula follows, sorry. Okay. Now, in summary of all the things I've discussed with you, they are summarized in this table. The summary of everything is in this table now. So in this table, you see those 6 economic parameters. Any question that you want to solve within the confines of cost, engineering, and economic analysis must fall into one of these 6. It's impossible for you not to fall into one of these 6. So these are the 6 universal economic analysis formulas. So it's either you want to find the F, you want to find the P, you want to find the A. And permuting them now, combining them now, it can come in form of, I want to find F, I'm given P. This one, I want to find P, and I'm given F. This is what you do. This is what the formula is. This is what the mathematical expression is. So these are the mathematical expressions, which I asked you don't even bother to memorize them, but take note of this, because with this, you are good to go with the interest table. So this and this, they are the same thing. If you're using manual calculation, you can use this to calculate. But if you want to make life easy for yourself, you just multiply the F by the interest table factor. Everything inside this bracket, we call it the table factor, which is under this notation. Everything here is called the table factor. Everything here is called the table factor. The table factor is just what you can go to the interest table and you pick it up. So everything inside this bracket, this parenthesis, is in the interest table. So once you pick it up, you multiply it by the P, you get your A. Here, you multiply by the F, you get your A, since A is what you're looking for. The first one, multiply the interest table factor by the P, you get the future factor. Any question about that, please? Okay. So if there's no question, let's solve 1 or 2 examples so that we can have a better grasp of it. So I'm going to introduce us to some of the examples. Somebody say, how do you get to know the current inflation rates? Okay, the current inflation rates we told we'll get it from the Google. I know it's 17%. Nigerian inflation rate is 17%. So I'll go to Google and say inflation rates in Nigeria. Oh, it's there already. Okay, many formula. So this is our inflation rate and value. Hold on. Look at it here. I'm wrong. 18. So inflation rate is 18.1% as at March. As at March. Then the other way to get it, sir, is you go to cbn.gov. CBN will give you. Okay, in 2020, the maximum was around January, and that was 16%. In May is about same. Look at it. Here is about 18%. Look at it. But here is 19%. So another way to get it is you just go to CBN. CBN inflation rates. To take you to CBN website. It's giving me this because I'm telling him images. So let me go to this. So this is cbn.gov.ng. Okay, let's continue. I'm just doing it to buttress what I just said. Okay, so as of today, as at May, the last one is around July. You can see it. Food item 21%. All items 16.3%. Whatever. Just go there. No need for that. Let's continue, sir. Okay. And that's all it is, sir. Just Google it online. Just Google it online. You see the rates. If I read through more, if I do the research, you see that's what it is. It's about that. Okay, now let's go. Okay, so let's do this example. Just a small example. If the present worth of an amount, okay, let's start from question number 2. I don't know if you have your, I'm going to give us 5 minutes break. 5 minutes break. Within these 5 minutes, I want you to pick up a sheet of paper, pick up a pen, and get your calculator around you. And then probably ease yourself because you're going to go into a lot of calculation now. We're going to go into some mathematical calculations. So it will be ideal. You pick up a piece of paper, a calculator, and a pen. So we're going to come back here in 4:35. So I'll give 2 minutes for question. Then we'll have a 5 minutes break, which is the middle of the class. Any questions so far? You can unmute yourself. In 2 minutes, let me take your questions in 2 minutes. Then we'll observe a 5 minutes break. Within that 5 minutes, I expect you to have a pen, a paper, and a calculator. You can use your phone anyway as your calculator, but just be ready and be in a position to do some small calculation so that we can make the class interactive. Let's begin to see how some of these costs can apply in real life scenario so I can sink in very well. So any question? So if there's no question, let's just observe a small break of 5 minutes. Please, by 4:35, we are back in class. By 4:35, we are back in class. I'm not going to wait for anybody. 4:35 we're blank because I want by 6 we can close the class and so that some of us can go home. So just get ready. If you have time, you can just be going through this question and see if you can tell me what they are looking for. Then when we finish, we'll come back to question 1. Question 1 might be a bit complicated for us, but I'm going to come back to it. So thank you. See you by 4:35. Also, open the interest table. Have the interest table handy. Open the interest table too. So 4 things: calculator, your pyro, your writing material, and the interest table. Open it and familiarize yourself with it. Okay. I think 5 minutes is up. Please, if you know you're back, can you go to the chat box and just say yes, back? Just say yes, just type yes. I want to see 10 people say yes. Go to the chat box and say yes. Let me know you're around. Okay, Tolutope, okay, Chukwemeka, okay. 3, 4, 5. 5 people, 6, 7. 7 people have said yes, they are back. 8, 8, 8. Okay, so let's go to the next question now. Hold on. Okay. This is the next question. A boiler economizer. What's a boiler economizer? Let me just say, a boiler economizer is something that you put to a boiler and it will make it energy efficient. That's just what a boiler economizer is. It's something that will help save heat, depending on where you're looking at it from. So don't be confused about it. Mechanical engineers will understand it. A boiler economizer will cost 20,000 and last 5 years. How much would the economizer have to save each year to return 12%? This is exactly. Yeah?
You have not shared the question. You can't see
Thank you. This is exactly, but I asked you to open your PDF. Notwithstanding, still open your PDF, sir. Cost and economic analysis, open the PDF. Okay, so this question is just the opposite of this one. Yes. Ooh, this is question 2, yeah. So this is question 2 now. A boiler economizer will cost, economizer is something that you put in a boiler in a big factory to help energy efficient, to help it save, it will help in heat losses reduction. You know, a boiler is something that produces hot water. So most times, if you don't insulate it, if you don't do some things to it, it will be losing a lot of heat. So, but a boiler will help you to save those heats. So if you put that in around the boiler, it will help to save the heat. So it will cost $20,000 and will last for 5 years. So the question says, how much will you have to save in energy cost or so in order to return 12% interest? So we go again. Okay, we go again. Thank you. Now, for this one now, it's just like the first one. Okay, but the difference is that this one, in this time around, we are looking for A, and we are giving B. And the interest now is 12%. So all this will change. Sorry, let me clean all of them. Just hold on. So the formula here will change also. So the formula here is not going to be, we're looking for A. And what are we giving? We're giving P. Right? Are you with me? So in school terms, you'll be tempted to use this formula here. But as I said, no need for all this formula again. This formula is here. Look at the formula now. We are looking for A given P. So this is the formula. But instead of this formula, please use this one, which is what you can pick up from the interest table. So everything here can be, that reminds me. I'm supposed to show us how to do the other one in Excel. So let me just do this one, then we'll do the 2 in Excel. Let's do this one, then we'll show you how to do the 2 in Excel. Okay. So what I was saying is, this is the formula to use. We are looking for A, we are giving P. So this is the formula we use. If you have to use mathematical expression as obtainable in schools, in universities, this is the formula, which is very complicated. And I said this formula is outdated, nobody's using it again. So the simple thing to use is your interest table. And after now, I'll show you how to use Excel, which is even the bigger thing to use. in terms of your professional development. So this is the formula I'm using now. So here, we're looking for A given P. When we go to the interest table, we will now look for where we have looking for A given P at a particular I and a particular N. So the first thing you do is you go to your interest table and use the appropriate interest table. And what is the appropriate interest table to use? The interest table showing 12%. And the number of years is what? 5. Number of years is 5. So we are now looking for capital recovery. We are looking for capital recovery. In other words, we want to recover the capital. And what is that capital? $20,000. We are about investing $20,000, and we are asking ourselves, how much can we be getting for us not to run into trouble? Knowing fully well that after 5 years, the program will come to closure. And the rate of borrowing, and we are borrowing this money from the bank at the rate of 12%. So how do we recover? How much should we anticipate, or how much should we expect from this investment of 20,000 for us to be able to pay back the money at 12% after 5 years? So I want the question to sink in. Okay, so we'll go back to our whiteboard. Sorry, sometimes you'll not see my screen. Just remind me so I can go back to the whiteboard. So here, what do you have here? The P is what? 20,000.
20,000.
We'll go to our table. We'll go to our table and look for where we have A, looking for A given P at interest, or let me even put this in this way. We're now looking for A given what? P at interest of 12% after 5 years.
Right.
So that will be 20,000 multiplied by, so I'll go to my interest table now. I'll go to interest table at 12%, the boundary condition had to be fixed, 5 years, have to be met. 12%, 5 years, and find A given P, capital recovery of $20,000 investment is giving us 0.2774. Can somebody confirm that, please?
Correct.
Others, can you confirm? If you confirm it, can you type it in the chat box?
0.2774.
Oh, somebody say you cannot hear from his end. Please, if you cannot hear me, it's not from your end. Like here now, it's going to rain heavily. The rain is very heavy in the sky now, so I don't know how it is in your place. So we might expect some network interruption, but thank God I'm recording it. So let's just stay with me. Okay, confirm from Izuku. Okay, you have confirmed it. So in other words, I will now come here and multiply 20,000 by 0.2774. And that's giving me 5548. It makes sense. 5548. So what is the meaning of this? It means that if this investment cannot give me 5,500 and above, it is not worth it. If I can't get a savings of 5548 and above, you should understand. Why is it and above? Because I'm the investor. Because the higher, the better for me, isn't it? The investment is not worth it. Are you with me? So it means for this project to pay for itself, the break-even point is 5,500. That is the savings. You know, one good thing about this thing is that if you look at it, a layman will tell you, Oh, is this 6 years or 5 years? 5 years. Yeah. A layman will tell you, if this investment is giving us 5,400 in a year, it means we're going to make 5548 times 5. Okay, 5548 times 5. That is 27,740. But let me ask this class, is this true? Is that what the money, is that the present worth of that investment? No.
No.
Because you didn't discount. So you see, that is why this class is important. With this class, you'll be able to see, like this might be like a contract. I know you can apply the contract. I was in Mina to do training for them. And they told me what they were experiencing, that some projects, state government will award a project. The project that's supposed to last for 2 years will last for 6 years. Now the question is, did you expect the contractor to finish the same project? No. The funny thing is that the contractor will now bring a revised estimated cost that will blow your mind. But if they have a knowledge of this, they will be able to apply the prevailing borrowing rates, or the contractor should prove how much the bank is borrowing him the money. Then we use that borrowing rate and extrapolate the worth of that contract or the amount of work that is remaining. That will help us to capture by what margin should we increase that contract. That is the end goal of this training. And those that have, that's why in foreign countries, believe me, when they give you a project that will last for 10 years, all these things must be factored in. That's why people like Josbega, when they bring their bill, and local contractors bring their bill, local contractors will bring low bill. But as soon as you give them that project, it becomes a problem. But those that have a knowledge of costs, their own bill will always be like the one of Josbega, because they have known that this project will not finish in 2 years. And inflation is 15% per annum. So instead of this project being 10 billion, after 1 year, the project should be worth 11 billion. After at 10%, after 2 years, this project is 12 billion. So if the project is awarded today, and I'm bidding for it, and the state government says the project will finish in 2 years, we will pay you up in 2 years. Instead of me, even if I've gotten my money, the cost of the project to be 10 billion, me, I will quote 12 billion. Why would I quote 12 billion? Because I know that after 2 years, the government will talk story. And if they say their story, I will smile and laugh because I've already factored it in the project. And if the project will last for 5 years, I will do future sum, which I'm going to do shortly, and be able to get the equivalent contract sum after 5 years. Only that I will minus it from the initial mobilization, let's say, or the initial payment. The other payment, I will spray it for 3-4 years based on some economic indicators. Any question? Did somebody miss it? Did somebody miss it? Do we all got it?
Yeah. Sorry, I missed it. I was out audio. I couldn't get it, but I'm back now. So
apology. It's raining. It's also raining. It's very windy. It's very cloudy here now. So what we did, sir, is that somebody wants to bring us economizer in my factory. I work in a flour mill or any of this big industry that uses boiler. And he's telling us that for us to save energy, that he wants to invest what they call a boiler economizer that will worth 20,000. And it will last for 5 years. And the prevailing inflation rate or interest rate is 12%. So we are now saying, how much should the boiler be saving us for the investment to be worth it? How much should we expect? Let me put it another way. Somebody wants you to invest in a business, invest 20,000 in a business for 5 years, and you want to borrow him that money at 12%. How much should the person be giving you every year so that you won't run a loss? You are borrowing somebody $20,000 for 5 years at 12%. You want to make 12% interest. This 12% could be that you have a Middle East investor who is giving you the money at 5%. then you have an office, you have a staff, then you have built in your risk. You know what I mean, risk. And everything came to 12%. So the value now, the point now is, how much are you going to charge that person to be paying you back every year? So that in 5 years, the person would have paid back the whole money. So what we did was to go to the charts, and we fixed the chart at 12%. Okay, and the payment terms, the payment period, sorry, or the lifespan, which is synonymous with the lifespan, is 5%. And we are looking for the annuity. We are looking for the annual worth of that loan. We are looking for the annual worth of that investment. We are looking at the annual worth of that project. We are looking at the annual worth of that loan. Meaning we are looking for A and we are giving P. We know the P. We know the initial investment. We know the money we are giving to the person. We know the cost of purchasing it. So under 5, we got it as 0.22, 0.277. Then if you now come to your table, you now multiply that initial investment. Sorry. Hold on. So you now multiply the initial investment by 0.22. It will give you the minimum amount that that person should be giving you back every year for the next 5 years. What we are saying is that if he gives you, if you got this, you can now tell the person to be giving you 60,000. Okay? You can now tell the person to be giving you 60,000 just for you to have extra change of 400. But anything below 5,500, you are losing. Based on this boundary condition, based on the condition that the money is borrowed at 12%, and it will last for 5 years. So the next thing we're going to do is, let's go to our Excel.
So, excuse me, do you mean anything below this 5,548 or anything below 5,005?
Sorry?
Do you mean anything below 5,548?
You are losing. You are losing. It's
anything
not what
below
it.
this 5,000, anything below 5,548, right?
It's not what it. Yeah, it's not what it. Yeah, anything below 5,500 is not what it. So the next thing I'm going to do now, I'm going to show you how to use Excel to do it. Why? Because part of what we're doing is capacity building. So just give me 1 minute. It's running now heavily. Let me take care of network issues. Just give me 1 minute. Open your Excel. There's a file called LCC in Excel. LCC. Just open it. Okay, I'm back. So let's go to Excel. So you can go to your material, you see LCC. Excel sheet called LCC. Do you have it? I will have
yes.
Let me share it on the charts also. Let me share it on the charts. So those who don't have it, I have it. On the charts for everyone. So if you don't have it now, go to your, just hold on. Sorry, hold on. So I've shared it. Are you with me?
Yes.
Yes, we are in.
Okay, so download it now. Okay, so if you go to LCC, okay, now question, the first, go to question P1. Please, everything in red, just remove them. Clean everything in red. Clean everything in red. Clean everything in red. Have you done that? You can see my screen.
Yes, done.
LCC, life cycle costing. Now, the first question we answered, I just want to show you the same how to use Excel. A new lighting system will last 6 years and save 5,000. So we all knew that we are looking for the present value, isn't it? So what you need to do is to design a table like this. This is very simple. Every engineer should be able to do this. So do a table like this, where you state the interest rates, you put the number of years, you put the, whatever that is not, you put the savings, okay? In Excel, the savings is represented as PMT. Just take notes. We'll still come to that. So now we're looking for the present value. So what you do is you put your mouse on this present value. Okay, so you put your mouse here because that's where you want to see the results. You now go to formulas. You go to formulas. Under formulas, you go to financials. Under financials, you open it. You see all the financial formulas possible. Under the financials, you go down and go to PV, present value. Here is it, here it is, present value. You click on it. A table dialog box will open. Now, anything you don't understand, just read what is written under it. Whatever you don't understand, put your mouse cursor inside the column, inside the box, and the meaning of what you should do will pop up at the bottom. Peradventure, not now, you want to learn more about it, you click on the help function, but don't click on it now. The help function will help you define it further. Excel is so simple and so self-learning that you just have to muster the confidence and you can do a whole lot of things with Excel. So the rate, we all know the rate is 15%. So you put your mouse here, don't make mistake, follow me. When the mouse is here, either you come here, you click on 15. So it will
Please, I'm lost. Oh, I'm lost. I can barely hear you, sir.
Is the weather, madam?
I'm so lost, please.
Is the weather? Is the weather, please? My apologies. So now you go to, okay.
I don't even know how you got to where you are now, because I can barely hear you.
Open the file called LCC in your material.
Okay.
There are 3 Excel sheets. One is cost practice, that for tomorrow's class. One is LCC.
Okay.
The other one is solver base. So open LCC. Then under LCC, clean everything in red because everything in red is the solved solution. So clean it. So
okay.
You format a table like this yourself. You format a table like this in Excel. You now go to formulas, menu formula. You go to the ribbon called financials. Under financial, you see a small flyout. You click on it. It will bring up hundreds of formulas for you. You now scroll down and go to PV, present value. When you click present value, a window will pop up. When this window pops up, this window will ask you for some information. And I was about explaining that when you interjected. So now, okay, recording is on. So now I put my cursor inside rates. It's either I click on this red stuff. If you click on this red stuff, fly out. You click on 15%. You press enter. It will take you back to the dialog box. Or you simply put your mouse inside the dialog box and then click 15. You go back, click on the next dialog box, which is number of years. You click on 6. You go to the next one, payments. You will not see A, but you see PMT. Take note of this. PMT is same thing as A in Excel. PMT is same thing as A. If you want to know, find out why, come under here and read it. It say, is the payment made each period and cannot change over the life of the investment? If you go to our theory, I also mentioned it when I was defining annuity at the beginning of the class. I think that's the only thing that changed. So that's to tell you that A is always also payment that is coming in. So the payment is 5,000, which is C9. The future value, you leave it blank because we're not interested in the future value. So what you don't need, you just leave it blank. Then under type, you leave it blank also. Type can either be 0 or 1, but at the beginning of the class, I told us that we'll be using what I call end of the year payment system, accounting system. That is what most of us use in Nigeria. We don't balance sheet in June. We don't balance sheet in February. We don't balance sheet in October. It's always by December that we balance sheets and pay our debtors that were borrowed by January. So the accounting system is January to December. So you leave it blank or you put 0. In Excel, 0 and nil and null sets, null cell are the same thing. Whether you put 0 or you leave it null, is it null or nil? It's null. It's the same thing. So now I have put in the rates, I have put in the number of years, I have put in the savings. So the program will now give me the present value, which is 18,922. That was what we got first. Remember? So I'll be giving us 1 minute to be trying it ourselves. This is it. If this project is attractive, then the maximum cost cannot exceed the PV of the savings cash flow. Thus, we seek the PV of the savings cash flow. The savings is now 5,000. None of the day, the present value should not be more than 18,922. He said this is the maximum we can pay for this project in order to receive at least 15% return. So if you're able to do it, just type done. If you're able to do it, I just want 5 people to say done. I want to see 5 people that have done it and got it right. How many of us will get 18,922 in Excel? If 5 people have gotten it right, then I know that the message has been received. Okay, Collins have done it. Tolu Pepe have done it. Muyudin have done it. Muhammad have done it. At least I have seen 6 people have done it. So can I get 2 more people? DBC have done it. Okay. So now let me give us one secret. Sukami have done it. When you come for training, capture the salient point. So this training has so much to offer, but I will just hit at the salient point. So now I've shown you where to get the formulas. So that is what your interest should be, to know where to find it. doing this table or copying this thing is not shouldn't be a big deal for you. If you want, I'll copy many templates. Okay, so let's go to the second question now, which is this question. Which is the last question. So look at this last question very well again. And it says we have the P, we have the words, years, we have the percent. So what are we looking for here, gentlemen and ladies? What are we looking for?
We're looking for the
Annuity.
We're looking for the annuity. What's another word for it? Savings.
annual savings.
What's another word for it?
Payment.
Eh?
PMT.
PMT. On that word, I
Payment-
can say is
Payment
yeah,
that
thank
cannot
you.
be changed.
Thank you. These are the payments. So let's go to Excel. That's good. I love this.
But I noticed one error here. You are putting negative 20,000.
Okay. I'll explain. That's a good question. I'll explain to you now. This one that we got, sir, is giving us, anytime Excel gives you something in brackets, it means negative. Now, this minus 20,000 is just sign. You know, the PV, in our cash flow diagram, we said anything that is going out is what? Negative. Anything that is coming in is what? Positive. So two of them cannot be negative. One must be negative, one was positive. So this one that we did, one was negative, one was what? Positive. Because this, why this one is in red and in brackets is because this is the amount of money that must flow out of your pockets. The negative sign or the red, the bracket, the parenthesis sign is telling you that this money is a negative cash flow, is an investment. So when you're investing money in cash flow analysis, it is disbursement, and disbursement is negative. So this one now that I put minus 20, if I remove the minus, the value will not change, but the sign will change. Did you get it?
Yes.
Good. So now remove everything in red. Delete everything in red. Let's do it ourselves. So now we'll go back to formulas. We'll go to financial. This time around, we're looking for the annuity. So we'll go to PMT. So you go and look for PMT. This is PMT. So click on it. My system have hung. I don't know why. Just wait for it. Well, go to PMT. Let me be talking. Okay. So if you go to PMT, under rate 12%, I'll come and click inside the cell for number of years or number of payment terms. That's why you see it says NPAR. Unfortunately for this one, the payment terms and number of years or the lifespan are coincidental. So the number of lifespan is 5. And the present value of the projects, the amount of money we are asked to invest, the amount of money that we are asked to bring out from our pockets is minus 20,000. I put minus because the thing is going outside my pockets, so that my answer will come back positive, something coming inside my pockets. So one must carry negative. We have no business with PV, FV, we have no business with type. So automatically the answer will pop up as 5,548. So this is the amount of money that the project must return. This is the amount of money I must receive every year for me to go ahead with that investment. If you have done it, please just type done so we can move forward. Come. Sorry, Okay, done. One person have said done. Okay. Can you explain again? This one is hard. Okay. This is the project. We've analyzed this one. So what I need to do is I go to formulas, I go to financial. I'm looking for the annuity, A, and I say in Excel is represented as PMT. So I go down and look for PMT. Under PMT, this is the rate, number of years, and it's not giving me negative because I should have told him that the PV is an outflow. It's not a receipt, it's a disbursement. The negative stuff. Okay. Can I have 5 responses, please? I hope it's not too hard for us. Can I just have 5 responses? 5 is just enough for me. So I can move forward. 5 responses from people that have done it. Okay, Collins have done it. 2 people have done it. I just need 3 more people. Okay, Tola have done it. Tolu have done it. Muhyiddin have done it. Okay, done. Okay, that has gone. That's good. Let's go to the next one. More complicated ones are coming. The idea of this is for us to have in-depth knowledge. If it's something that you can capture as a take-home, I think it's worth it. And meanwhile, let me have at the back of our mind that we will not be able to finish all of them, but there are some examples that I'll leave with us from number 1. Please, for you to be in this class tomorrow, please, you have to attempt these ones. And attempt them using Excel. Don't crack your head too much. Okay? Okay, so that, because if we say let's keep solving all of them, then it might take us another 1 day, which I don't want, because we still have a lot to cover. Okay. Okay. Now look at this formula. Look at this one now, very, very fast. A company has asked you as a cost engineer, you have attended this course, to look at 2 projects. Each project will last 8 years. The first project cost $125,000 and will save $33,000 each year. The second project will cost $153,000 and will save $46,000 each year. The company has a discount rate of 12%. Which project will you recommend? You are the cost engineer, you are the cost professional, you are the engineer, and somebody is bringing 2 proposals to a company that have the same interest rates, the same lifespan, but have different investment costs and different savings. And the question is, how do you advise your company? Any idea?
Well, from my own perspective, just looking at it physically without doing the estimation of what would be the savings, I think I would say we should go by project 1, which will cost $125,000, and we'll be saving $33,000 yearly.
Okay, thank you.
That's
that's a good engineering case, but let's do it based on principle. So let's go to work. Let's work it out. Let's work it out and prove it beyond reasonable doubt that you have made your decision. Your decision is good. So number one thing I want to say here is that you're going to treat this as two different. You're going to do the analysis twice, differently. You're going to analyze this one and get their present value. Okay, and then you analyze the other one and get their present value. Are you getting me? So now, are you with me? You analyze the two parameters and then look at which one. Okay, somebody said I'll go for the first project, but let's prove it. Let's prove it's good. You've all answered well. So what you do now, gentlemen, is very simple. Watch me now. Stay with me. So let's call this project 1. Project A. So, and then we'll call the second one Project B. Now, I'll use the first formula. There are 2 formulas to solve this actually, but let me use the first one. I'm going to use the first one because the project have the same lifespan. They have the same what? Lifespan. So it means I can bring them from the 8 years and bring them to the present. So I'm going to use what we call present worth method. So in other words, I'm going to use NPV, net present value. What is the net present value of the project? Now, net present value simply means the present value of the savings. Stay with me. Minus present value of the cost. Let me give you a simple analogy, and I said in the beginning. I bought a phone to be doing online business. I bought the iPhone, because of pictures and digital and everything. And the iPhone cost me 100,000. Is what it cost me 100,000. And I have done business with it, and I made 150,000. And then the iPhone got missed or got damaged beyond use. So the cost of the iPhone is 100,000. And the savings, the money I made from the iPhone is 150,000. So if all of them are in the present terms, it means that the NPV is going to be 150 minus 100,000. So it means the net worth of that investment is 50,000. That's what NPV means. If the net present value is negative, we are losing. And if you have 2 projects and both of them have positive NPVs, the bigger NPV becomes the better project. Gentlemen, it makes sense. And ladies, it makes very sense. Okay. I bought something for 100,000 and I made money and made 150, and the thing died after 1 year. It means the net present worth of that investment is the present worth of the investment and of the savings and of the present worth of the investment. That's what NPV means. So that's the formula we use. First of all, is project A worth it? That's even the question you ask yourself. Is it worth it? So let's see whether the project A is even worth it. Say that the first project, sorry, stay with me. The first project will cost 125 and will save 33,000 for 8 years at 12%. First question is it a worthwhile investment? Let's even know, is it a worthwhile investment? And if it is, what is the margin, the profit margin? That profit margin in economic terms is what we call NPV, net present value. So is it really worth it? Is it worth it to start with? So now we're now going to do for project. So we'll focus on project A. So take note, open your value 125,33,000. So we'll come here, we'll say that project A the PV of the cost is known. And what is it? 125,000. The PV of the savings, do we know it? We don't know it, but we are giving some values to get it. Like the A, we are giving the A. And what is the A? Yes. And we are told that it will last for 8 years and that the cost of borrowing or the banking rate is 12%. So with these three parameters, we can get the P. So the P from our formula interest table is given A into what? P over A at 8% at as 12 at 8. Are we together? So P over A 12 8 will go to our interest table. Our interest table of 12%. Look at it. Under 8 years. So this is 12%, 8 years, or 8 payment terms. If it is a monthly something, this becomes 8 months. 8 months. Take note. So we are looking for the P given A. So we're looking for the P. So we're looking for the present value. That's column number 6. Column number 6, are you with me? At 8 years, it is giving me 4.968. Can somebody confirm it? 4.968.
Confirmed.
Somebody has confirmed 4.968.
Confirm.
Yes, 4.968.
Okay. That means I will now come here. If I now come here, I will now compute and say P is now, the savings is 33,000. Multiply by 4.968. And what would that give me now? Sorry, I'm on my calculator. 4.968 multiplied by 33,000.
163,944.
No, 163,944. Thank you, sir. 163,944. 163,944. So let me ask you a question. Is this investment worth it? Is it worth it?
Yes.
What this
Yes.
is telling you, well, thank you. What it's telling you now is that if you have to invest 125 now, today, even though the project will last for 8 years, if you want your money today, you get 163,944. Why this is important is that it will help you to know whether the invest. If somebody brings you another proposal that will give you more than this, you will take that one. That's why we call it economic analysis, and that's why it's in cost engineering. So now the NPV of this investment is now 163,944 minus 125,000. Thank you. So it has a positive NPV. Remember what I said? At the point where the NPV is equal to 0, is what we call the IRR, internal rate of return. That is what the bank uses to set their interest rates. And that is what every company uses. Some company, if they do a contract and make 5% profit, that 5% will not be able to pay for their rent and their tax. And that's why some engineering companies, after a few years, they fold up, because we're not able to capture the worth of our overhead in a year. So that if somebody is giving us a job that will take our staff for 1 year, you should make sure that those investments will take care of the salary of those staffs, take care of fueling your vehicle and partying and every other thing. That's by the way. Okay, so 163,944 minus 125,000 is giving us 38,944. So the project is a good project. It has a positive MPV. In other words, we're not running at a loss. We're going to make a small change. And that change is how much? 138,944. In today's time, in today's value, not after 8 years, because you don't know what will happen in 8 years. That's why if you're making investments, you're making costs, you should bring it back to present time, because we are drilling on the present. So now, how about project B down? We're going to do the same thing we did here on project B.
Okay.
So just copy this, paste it here, but change the values. So here becomes 153. Are you with me?
Yes.
And here becomes 46.
46.
So those that said that project 1 is the best one, we're going to see. So what do I do? I'll go back to my table.
Go to the chart.
I'll go to my chart, sorry. But since it's the same chart, it's the same number of years, are you not going to get the same value? Please, can somebody get it? What do you get?
It's the same value we'll get.
Of course, it's the same value, because it's the same parameter,
Yes.
the same boundary condition,
Yes.
isn't it?
Yes.
Remember what I
Yeah.
told you about modeling? When you're doing modeling, when you the same boundary condition, you know, those days when I was in Germany, if you want to do modeling, you say, no, sorry, what am I even saying? Sorry, I'm speaking to engineers. In our chemistry class, under constant pressure and temperature, okay, that's what we call boundary condition. Meaning, in other words, for that chemical reaction to go as planned, the temperature and the pressure must be constant. So that is what we call fixed boundaries. In other words, if you do it outside variable temperature, variable pressure, Le Chatelier's principle will not hold. So it must happen under some controlled environment. That's why most times when you give people money to do business in Lagos and Abuja, don't expect them to bring the same return for you, because rent is cheaper in Lagos, food is cheaper in Lagos. In Abuja, it's too expensive. So the person in Abuja might not, but then the other factors that will balance up. That's by the way. But I want us to understand the whole concept. So now the value will now be what? 4,600.
4.968.
4.968. And it's giving us 228,528. Therefore, the MPV becomes what?
22828.
Minus 15300.
15300. 7528. So which one is better investment now?
The second one.
The second one.
So all those that say all those that say the first one, you can see now how you fail, why people fail exam. You can see it now. So that's why
I got it right.
Who got it right?
I did, Victoria.
You mean by guess? You mean you got it right by guesswork?
No. I used the calculation to come up with 75,528.
Kunaka
for you. Kunaka.
Would you have predicted fine if you have not done calculation? That is why we are engineers. It is not by calculation. It's not by guesswork. We don't do guesswork. We must walk the talk, and this is the only way to walk the talk, by applying these principles. So we have 10 minutes to end the class. So let's go to Excel and do it with Excel. Any question? So go to Excel. Go to Excel, and I've used two methods to work it, but let me show us the present words. You see where I use the present words to do it. So all you need to do for me is clean all the reds. Clean all the reds. Clean the answers. Why not save it? Some of us must have made this mistake unless you finally get it right. But if you know you're going to fail it in Excel, it's better you save and then save it again and then call it trial. I'm sorry, this idea came late. So that if you make a mistake, you can fall back on the original. Okay. Now, go to the Excel. If you go to the Excel, if you go to Excel now, you'll see under sheet 3. Let me rename it now and call it MPV. MPV question. Whatever, sheet 3. Open sheet 3. So remove everything in red, which is the solution. So now, for the question again, we all know the interest rate. So we split this question into two. When you are given a question in cost, find time and break it down into economic terms so they can be able to solve them. So here we have the rate is 12%. The number of years is 8. The present value is 125. The savings is 33,000. So I click on my PV. I'll go to formulas, financials. Under financials, you go to PV, present value. The rate is what? 12%. The number of years, 8 years. The payment. Can you see this one? The payment is what I will use this time. I will ignore the PV. Enter. How many people got it? How many people got it? Just say yes. If you done it and you got it, just say yes.
Excuse me.
I can hear you.
But why did you use negative sign on that PV?
No, I didn't even make use of it, sir. I can remove it. I didn't make use of PV. But as I said, PV is the money going out of your pockets. That's why it's signed. The money that's going out of your pockets. Okay. So now that I've removed negative, let's continue. So because of want of time, let me also do the second one. So if you have not done yours, you can watch me. Let me do the second one. Go to this. Well, the same thing, basically the same thing. Go to PV. The present value. Remember, I'm not even making use of the PV here. It's just there. It's just there as for nominal. I'll use it for the calculation. The number of years is 8 years. The payment term is 46. So return this for me. Why is it negative? Why is it in brackets?
I know. So this time around, you didn't use the PV. You didn't use the one.
No, I didn't use the PV, sir. I don't have to, because I'm looking for, it's not my business, you know, I don't need it. What I'm looking for is the PV of this annual. It is when I'm now doing the NPV that I'll now make use of it. And that's the next thing I want to do now. So now it means that the investment costs. So I want you to see this as initial investment. Let me put in brackets. Initial investment, okay? Then this value that I got now is now the revenue. Are you with me? It's now the total revenue. Yes, I think that's the right thing to use. So from what I taught us, if the MPV now is automatically this minus this, so which will be the revenue minus is now equal to this minus this. Why did I put minus? Why did I put minus? Because initial investment is negative in my cash flow diagram and revenue is positive. If you put two of them positive, it doesn't make sense. So that's why I put negative. So bear with me. Cash flow negative, inflow positive. If you do observe that, you'll make a mistake. So in this one now, the MPV is now, let me copy it, for project B. Sorry, don't stay with me. So let's go now. The MPV of this one is now automatically this minus, equal to this minus this. One has to be negative. What is flowing out of my pocket and what is coming into my pocket? Did you grab it? So I even have to come and say, sorry, Max, okay. Now, we have used what we call present worth method to solve this question. There's another method we can also use, but for want of time, I might not go into it so that some of us can go home. Well, let me just show us what we can do in Excel. If you look at the Excel, based on what we have done, some of us can easily do it. Okay. If you don't want to use that method, I can use the annual method. Now, what is the annual method? Annuity method. What I simply do in annuity method is that I will find if somebody gives you 125,000 and the money is bringing you 33,000 every year, what is the annuitized cost? Now, stay with me. This project is costing us 125,000 and it will last for 8 years. The question you ask yourself is, what is the cost per year? What is the cost per year? I said it at the beginning, if you buy a car for 2 million and the car will last only for 2 years, it means the annual worth of that car is 1 million. If you bought a car for 2.5 million and that car maximum, you drive it is 5 years. After 5 years, you start giving you a headache. And the salvage value is 0, which is not possible anyway. But let's assume that the salvage value is 0. At that point, it means that the annual worth, the simple, let me use the word, simple annual worth of that car is 500. Because if you are doing the discounted cost, we all know that it's more than that. So now this project is going to save you 33,000 naira per year. And it will, how much will it cost you per year? How much is the cost per year? So remove all remove all the reds. How much will it cost you per year? This is how you spray payments. Instead of you paying one bulk payment of 125,000, how much can you be paying every year? That's what we're talking about. So I'm going to get the cost of the annual cost of the annual cost of the projects. What is the A of the PV? What is the annuity? What is the series of payments per year that will be equivalent to the initial investment cost of 125,000 that I'm investing? So let's go. So you click on the mouse, you click on financials, you go to PMT, which is the A, the annuity. Don't be confused with this annuity here. This annuity here is annuity for the savings. That's the money, but I'm looking for the annuity of the cost. So the rate is 12%. Number of years is 8 years. The present value of the cost is 125. It means the money per year is 25,000 naira. What it means is that is either I invest 125,000 now, or I am paying 25,000 every year for the next 8 years. Who didn't understand it?
All right.
Hello?
If you go to buy motor from Coscar, before you ask a question, if in Europe, let me tell you, not what we do in Nigeria. If you go to Europe, you go to any phone company and ask them to give you a phone with data, contracts as they call it, you will only pay monthly. Maybe for 2 years or for 3 years, depending on how you want to space it. So that is what we are doing here. So what they'll do is that they will spread that cost for you for a period of 8 years. If you go to Coscaris now to buy a car, and you told Coscaris car that you don't have money, and you want to pay in 8 years, and the car costs $125,000, Maduka, for him to make a profit of 12%, he will ask you to be paying $25,000 every year for the next 8 years. That is the same thing as paying 125. So what you do, if you look at it, 125,000 every year, let's do something equal to this multiply by 8. You see why people prefer to pay off. At the end of 8 years, the total money you would have paid Coscas Maduka is $201,000, $200,000. So why not you just bring out 125 and pay him off and go and rest? Though I must admit that this interest rate is very high, but it's quite high. But then, considering the Nigerian factor, who do you blame? Because in Europe or in all these developed countries, this interest rate will be like 2%. Let's say 3% here. You see? So after 8 years, you will have only paid 142,000, as against paying 125 one-off, because the interest rate is low. Question, sir. Is it understood? Any confusion? So back to the question. So to get the net now, what I need to do is to say, if what are we paying bank to bank is 25,163, and what the revenue I'm getting per year is 33,000, it means that the net amount I'm getting will be this minus this. So the net amount I'm getting per year, annuitized, per annum, is 7,837. Whereas for project B, let's do for project B, PMT, rate 12, years 8, present value this. And for project B, I'll be paying back for this loan. I'll be paying back 30,799 every year for 8 years. But the money revenue they are paying me per year is 46. Therefore, when they pay me 46 and I pay back the cost of capital, I'll be left with how much? This minus this. 15,205. So you, which project will you invest? Is it project A or project B? Which one?
Project B. Project B.
So you can see that whether you use one method or use another method, you always get the same answer. Question, please. Any question? Any question?
Yes, sir.
Mhm.
I just want to come back to my first question. I
Okay.
just need some clarification.
Okay.
When you say this is the lifespan of a project,
Mhm.
you say 20 years. How do you determine the lifespan of a project? That's number one. Then number two, each equipment may have different lifespan.
Thank you.
Does that add up, or you take the one that is going to be for longest or minimal lifespan? I'm just trying to look at it. If you can throw more light on that, I will appreciate it.
Okay, thank you. Let me start from the last question, man. Thank you for that last question. That last question, you have to use formula annuity method to solve it. Why we attempted to use MPV to solve this problem is because they have the same lifespan. They have the same lifespan. But if the project have different lifespan, we are going to use the annuity method. And that's exactly the solution in question number 4. Unfortunately, time will not allow us. So I have two options. Either by tomorrow, I will start with this question before I go to what we have tomorrow. Or I will say, go and review it at home. So what you will do, if the project have different lifespan, you annuitize it. Your interest will be, what is the net amount I'm getting per year? So that if this one is lasting for 10 years and one is lasting for 20 years, it's no more your business. Your business is that based on me investing 25,000 every year, I'm getting 33,000. So my net is 7,000 naira. And this 7,000 is constant. That's why we say is a constant series of payments. So with this, you know that, look, all I know is that at the end of every year, I will make my 7,000. Okay. And by then you must have taken into consideration that the 7,000 will take care of all your bills.